Hey everyone, Ben Nelson here, the Everyday Real Estate Investor. Thanks for tuning in here on the Everyday Real Estate Investor podcast. We're focused on mindset and strategies and tips and tactics, tools, all those things that can help you in your real estate journey when you are super busy with other things, right? We've all got a lot of things going on. We're not all full-time in real estate, but we still want maybe some exposure to the real estate investment world and the benefits that can provide. So that's what this podcast is really focused on is how can you be busy, maybe not necessarily full-time, totally awesome if that's a goal of yours, or maybe you're trying to scale your business. Maybe you are full-time, but you're struggling to do that and looking for some ways to be more effective and efficient. So that's what we're focused on here. I am a real estate investor. I am a real estate broker. So I'm in the world of real estate on a day-to-day basis, but my brokerage activity keeps me very busy. So my investment business, my investment activities have to fit within that. So I even though I'm involved in real estate on a daily basis, I still understand the struggle of trying to find time for everything that you want to be doing and trying to fit that in. And I have a family. I have try to have hobbies and things that I do on our property and things like that. So I'm very busy, but I'm still finding ways to be involved in real estate investing. And so that's what I want for you as well. If you want to be involved in real estate investing, figuring out how to make that happen. So thanks again for tuning in. Today we are going to talk about maybe something that can help you with getting more involved in real estate, either kind of starting out and getting going, or maybe show you some ways that you can scale your business and build your portfolio in ways that you maybe hadn't considered before. So we're going to talk about equity today. So equity is great, and if you've been in the market, if you've owned real estate at all in the last few years, more than likely, not every market's the same, but more than likely you have gained quite a bit of equity, right? Your value of your property has increased quite a bit compared to what you paid. So now you've got this newfound equity. So the question is, what do you do with it? Equity by itself is really not helpful. It doesn't really do a whole lot for you if you just leave it sitting there, because you paid for this property 3, 4, 5, 10 years ago. You've still got the same amount of debt on it. Maybe your rents have increased, so your cash flow has gone up, but you have all of this value, all this equity sitting there that could be being used, and it's not. So that's what we're going to talk about today, because this is a fantastic way to tap into some more resources that can help you build and scale your business and help you build your portfolio. So you don't want your equity, don't let your equity be lazy. It should be working for you. There's a couple different ways you can do this, and really the two main ways are, you can refinance. It doesn't necessarily have to be refinancing your whole existing loan, but you can get a loan, right, to access some of that equity, and then now you've borrowed against that equity, and now you have some more cash to go out and work with. So that's one way you can do it. The other way you can do it is you can trade, right? So you can take your single family home that has equity, and you can take that and you can sell it or exchange it if you're doing, a tax deferred exchange, maybe to defer those gains. And we won't get into the weeds on what that looks like today. Just know that that's a tool that you can take that equity and you can sell that asset, and you don't have to necessarily pay capital gains on that if you do it the right way and follow the right process. So there's a lot of nuances to that. You definitely want to talk to the right professionals if you are looking at doing something like that. Tax professional, see what your situation would look like if you are going to owe capital gains. How much is that going to be? Get some projections, and then talk to a 1031 exchange custodian specialist that deals with that, and they can help you through that process. So if you've owned property and you've sat there and watched the market, it's done really well for you, but you haven't really done anything with your equity, what you really want to do is you want to sit down and you want to look at what is the current value of your property and what do you currently owe, and find out how much equity that you have, because now you can look at your scenarios of what are my options, right? What can I do with this equity? Is there something I can do with this that's going to give me a better return? So the first option, again, is to borrow against it. So if you're going to go out and get a loan, obviously that's probably going to affect your cash flow, right? So you are potentially giving up cash flow. You might have, $500, $600, $800 of cash flow if you've started out with something maybe that broke even or got a couple $100 a door when you first bought it, market rents have gone up, your payment hasn't increased because you haven't done anything with the debt. And so, yeah, you're like, oh, now I'm making $800 a month instead of $200. But the thing is, if your property has gone up, a lot of markets have gone up, 15%, 20% a year for the last few years. So you had a property that 3-4 years ago, you paid $250,000 for it, $200,000 for it. Now it's worth $450, $500. You could potentially go in and, get a 75% loan to value. A non-owner occupied, rental property loan is pretty typical. Now rates have continued to tick up. So that's, an unfortunate downside of like, this would have been better to do probably, 3, 4, 6 months ago, but it still could make sense if you can get a better return from that, because you can still borrow, 4.5%, 5% for a non-owner occupied loan. And the bottom line is if you can go out there, if you're not feeding that, if you can pull that equity out and you're borrowing against that equity and you can make more than what you're paying, you don't want to be feeding your property every month. You don't want to borrow to the point where now you don't have any cash flow to control the debt, because that's how you lose control of your assets, is when you lose control of your debt. So you want to make sure you still have some cash flow, you still have a little bit coming in for reserves. You're not feeding the property on a monthly basis, because that's where you end up in trouble, is when you have situations like that where you lose control of the debt. You want the property to take care of itself. But if you can do that, if you can borrow, still have a little bit of cash flow, and now go out and use that, now you can buy another asset versus just having equity that's sitting there, right? So you look at that example. So say you paid $250,000, 4 years ago. Now it's worth, $450,000. You've got $200,000 of equity, that newly created equity, not accounting for anything that you might have put down at the time. Even if your cash flow goes down to, a couple $100 a month instead of $800, would you rather have an extra $600 a month in cash flow, or would you rather have, $150,000 if you could take 75% of that, just for quick numbers, and pull that out? That's 20% down on a $750,000 property. So now you can build your portfolio, you can build your assets, and you can continue to build your wealth, because really, in the end, if you're continuing to pay down your property, that's great. You're making your payment every month, you're paying it down, you're gaining equity that way as well, right? You're paying your loan down. But in the end, most people have 30-year loans. So, and I broke this down in a video series that I did as well, where you take, one property that you bought and you kind of extrapolate it out from when you bought it to 30 years later, and basically doing nothing. And you have to make a lot of assumptions, of course, but in the end, you end up with one property that's worth, quite a bit more than what you paid for it. And you have a free and clear property, and it's cash flowing, very nicely, right? Because you don't have any debt service on it. But when you compare that to making just like 2 or 3 strategic exchanges where you take that equity and you exchange that property to something else. And I know we were just talking about, getting new debt on it, but the difference is huge when you make some strategic moves and either leverage and buy more, or exchange and buy something, larger. And it's just, if you're interested, feel free to shoot me an email, info@theeverydayrealestateinvestor.net. I'd be happy to send you the video series, but it gives a really good example of where you actually would end up in 25 or 30 years if you just make a couple moves. And it's a huge difference. It's not even a small difference. It's not twice as much. It's not 3 times as much. It's like 10 times as much as far as your amount of assets, your asset value that you own, and you still have great cash flow if you do it right. So now, if you are borrowing against your property, so what I would talk to a lot of people about is, so if you're looking at wanting to buy more, we talked a little bit about the house hacking, that whole strategy recently. We talked to Mr. House Hack, right? And we talked about that strategy, and where you can get great financing when you're buying something that's owner occupied. And if you're going to invest in real estate, that's a really good way to get into property with better terms and lower down payment, because you can turn around in the future and turn that into a rental property and still have the benefits of that excellent financing that you're not going to get when you're trying to just buy something strictly as an investment. along those lines, one of the things that you want to look at, if you are living in a property currently and you're like, hey, I want to keep this as a rental, I'm thinking of moving on to something else, I highly encourage you to first, before you do that, see how much of that equity you can get to, because you're going to get a lot better terms and you're going to have a lot easier time getting to that equity while you still live in it and as your primary residence. So I have some clients doing this right now. We're looking at some options for them. Long term, it's probably going to be a rental property, but right now it's their current residence and it's going to be for a while. So we're looking at that. You can get a lot higher loan to value. You can get a lot better interest rates, and now you've tapped into that equity and you have access to it, and you can use that cash to go, buy another property. Whereas if you turn it into a rental property first, then try to get to that equity, it would be a lot harder. You wouldn't be able to get to nearly as much of it, and it's going to be more expensive. So that's the first thing. The second thing is there's several options out there for tapping into equity if it's your current residence. And again, there's two kind of main quote unquote main options, but you can get a fix. So say you don't want to touch your existing financing, you've got a great rate, rates have gone up a little bit, but you still want to get to the equity, right? So you could get a fixed rate term loan, okay? Or even if you refinance the whole thing, you get a fixed rate term loan or a fixed rate term loan, like a second position one, or you can do a home equity line of credit. They both have pluses and minuses, okay? So you really have to think this through and think out what's better for you. And a lot of people gravitate towards the home equity line of credit because rates are a little bit lower, at least right now, than your fixed. A lot of times they're interest only, so your payments lower, your committed payments lower, and you're not paying interest on it unless you draw on it, right? So it's an equity line. So they'll open the line of credit, you have the access to the capital, but unless you draw on it, you're not paying interest. So that's appealing to a lot of people. The thing is, because of the reverse of that is if you get a fixed second or a fixed loan, right, you're paying right away. As soon as that loan is done, say you get another loan on your property, it's $100,000. As soon as you sign the papers, it's a fixed term loan, you're paying interest on that no matter what. Whereas on a home equity line of credit, you could get a $100,000 line of credit, you're not paying interest on it unless you go out and use it. So the trade-off is, and we talked about this at an investor meeting last night that we had, that people forget, or maybe you haven't gone through it, or you weren't in that position at the time, back in during the financial crisis, and it's in the paperwork, if you look closely, they can call home equity loans due a lot of times. So if they decide that they want to close the line of credit, they can close it, they can call it due, or whatever. So that money is no longer available to you. You may think that, I have a $100,000 credit line, I'm good, I can go out and use that whenever I want. But they may not. They at some point, if there's a scare or they pull back, or for whatever reason they decide that things are getting dicey, they could decide to shut that down, and now you don't have access to the capital that you thought you had. I am personally a fan of the fixed term loans because, and so the other thing is that you're usually very variable rates. So right now rates are good, but if rates continue to go up, it's going to be higher every month, right? So you don't really know what to expect. So if you're buying something, you're using the debt to buy another piece of real estate, another asset, you want to make sure that the current property and or the new one that you're acquiring is servicing that debt, right? So the problem is if you don't know what that payment's going to be, and we're in a rising interest rate environment, now you have more risk, because you might be fine today, but in 6 months, 12 months, 18 months, you might find yourself in a position where you're upside down on your cash flow, and you don't want to be in that position. So I'm a big fan of getting a fixed term loan if you're trying to get to your equity, because you know what to expect. It's fixed. You don't have the you're not going to get it called due or shut down or anything like that. You sign on the line, you get the cash in your bank, and you're good to go. You just have to make sure you service the debt. So yes, you are paying on the interest. If you and if you're not using it, you're just basically paying a fee to have cash in the bank, right? And you don't want that. So there's a little bit more pressure to go put it in to work for you, so you're actually making money on that instead of just paying money on it. But in my opinion, the benefits of having it be predictable, and what your payment is, and the money's going to be there and not going to get called due or shut down or anything like that, to me that outweighs the benefits of the HELOC. So that's my opinion. you have to weigh your own risk tolerance and all that stuff. But those are kind of the two options. So what I want you to do is I want you to take a look at any property that you own right now. And if you don't own property, I hope you're still listening and understanding this concept and just kind of taking this all in, because it will come to play sometime if you're in the real estate game. So I want you to sit down. I want you to take your properties. I want you to, even if it's just a ballpark value for now, even if you're just going on Zillow or Redfin or something like that and taking an estimate. And then I want you to take your loan statements and I want you to look at what your equity position is, both from a dollar amount and from a percentage amount, because your loan to value is going to come into play as well, right? So, and then I want you to work all those numbers. I want you to see how much capital you might be able to get access to, just kind of using 75% loan to value for anything that's a rental property currently. And then, 80, 85%, there are even some banks that'll go up to 90% on something that you live in currently. So I want you to do that. I want you to find that number. And then I want you to think through what are your next steps that you could take if you were to pull that equity out. And do you think you can get a better return on that by buying something else versus just keeping that compared to the amount that you're going to be paying on a loan that you get against that equity. So, and we talked about the 4 different parts of real estate return a few weeks ago. If you haven't listened to that episode, go back and listen to that, because that's going to be important in part of in part of this analysis is, if you're borrowing at 5%, can you turn around and make more than 5%? And there's a lot to that puzzle, and you want to make sure that you're looking at all of those pieces and not just one part of it, because you may think you're not getting enough of a return for the risk, when you factor all the things in that go into real estate return, you could be getting a lot larger return than what you think you are. So I encourage you to go back and listen to that episode if you haven't already. Learn about the 4 different parts of real estate return, and then make sure you're accounting for all that when you're looking at what your options are for replacement property if you're trading up, or for if you're deciding just to leverage what you currently have, not sell it in an exchange, and then buy something else. So hopefully that's helpful to you guys. Again, my goal is to just be putting out ideas and thoughts and strategies that can help you move forward in your real estate investment business. I really hope there's some people out there that are listening to this that maybe have just their current residence or maybe that in one investment property or something, and they haven't really thought about using that equity, or they really weren't sure. Maybe they have thought about it a little bit, but they're really not sure how to go about that. And now hopefully you have some steps to go out there and work through this and really think through it some more and try to figure out what to do and look at some options for tapping into that equity and using it strategically to build your real estate portfolio. So thanks again for tuning in, everyone. I appreciate it. Hope you keep tuning in and learning a lot. Feel free to reach out and connect. I'd love to connect with anybody listening, and make it a great rest of the day. Until next time.